market's kind of like not interesting, we'll do a quick run around, and then we'll get David to show us some of the stuff that he does, because it's very, very interesting.
Nice.
He's got real expertise.
Nice. Good morning, everybody. How's everybody feeling about crypto today? Let's have an emoji for how you're feeling about crypto.
Here's an emoji.
It's
Are you while we're on to fucking things, you want to see a shit trade? Let's have a look at a really shit trade. Scott buys.
Yeah. Did you buy SITA? Really?
It's paying 2,000 fucking. What's it paying?
Okay. Yeah, the funding rate.
It's paying 744% carry. And I looked at all the wallets. It's like, it's definitely a scam, right?
Yeah.
So let's look at this bitch. Zito. So this, oh, look who's back again. Okay, so let me show you guys something interesting about, let's look at, oh no, it's a daily chart. That's why it looks shit. Okay, so this aggregated spot trade count is very interesting, because what the number of spot trades tell you is if a market maker is doing bullshit fake wash trading, just to create an illusion of like gradually pushing it up, right? So you can see it went from 80 trades every 5 minutes, like 20 a minute, to like fucking 1,000 a minute, 1,200 a minute. So this is someone trying to ramp it up. And it works because the spot price, the price goes up, but also they're increasing they're increasing their can you make David David Holt a admin, please? Like, bring him up here with us, panelist. So here they're increasing their long position while they're manipulating spot up. So they're paying for their spot manipulation with a bigger position here. Now we've got from, let's change this to aggregated open interest. Hey David, how are you, man?
I'm doing good, man. Just started my day, but yeah, doing well. How are you guys doing?
This is the first time. Great. This is the first time you've met some of these guys. So Ian Hamshaw is our community manager. I taught him to trade like 2020, and Maurizio has been trading a long time. We've been trading together for over 5 years. David is a very, very good perp futures trader. He founded a Solana coin which went broke when FTX went down, which was not his fault. A very good coin which was basically like Pendle for Solana back in the day. Really good idea. Should have taken off, didn't. Thank you, fucking Sam. Fuck you. And ex-market maker, very good execution trader, and he's going to be running the vault for us. He knows a lot more about this. So I'm in this stupid fucking Zeta thing. Have a look at this for a fuck trade.
Yeah.
I bought here. It was paying 2,000% long. I looked at it and I thought, this is clearly a manipulation upwards. I thought they were, it's obvious what's happening with the premium here, but I figured they were just shaking out the tourists before they give it another go, and it looks like they're giving it another go. So we might start with, why don't have you got a computer with you, or are you just on the phone? Dave?
What, me?
Yeah.
Yeah, no, I'm on my computer. I'm on my computer, yeah.
Do you want to share your screen and whatever indicators you use, and just go through Zeta and just read the read the tape the way you see it with open interest and price and what you think is happening there, because I think that'll give people a good idea of you know for the guys who are watching this for the first time, David's even better at this stuff than I am. So in fact, much better at this stuff, and he's got better hair. More of it.
I don't know about that. It's a fucking mess today, but let me see. Let me get prepared to actually share my screen here. That way I don't have random shit that you guys don't need to see on here. You know, all the hentai or whatever. Kidding.
Classic jokes never grow old, do they? I'll just shut Paul up.
Yeah. So actually, I don't have anywhere I would know to look for Zeta specifically, except for like on TradingView. So I guess we could just do that.
And you're probably going to need open interest though. Can you get that on TradingView?
Okay. Yeah. What charts do you got? Where's your
ELO.xyz is really good for that for this.
What is it? Sorry.
ELO.xyz.
XYZ. Okay, cool.
There we go.
There we go. Now let me share my screen here. There we go. Let's do that one. ELO.xyz. It doesn't seem to be.
VELO. V for vagrant. V for vermin.
Oh, gotcha. There we go. That looks a little bit more like what we're looking for. Okay.
Go to chart. Top left. There's a hamburger, and go chart. Okay, and indicate.
There we go. Okay, so what specifically where are you trading? Are you on Binance Futures or Bybit?
I'm trading it on Hyperliquid, but it doesn't really fucking matter. Binance is the leader here, right?
Okay. Let me see.
And you can add open interest, aggregated open interest, and premium. You can add spot tape. You can add a whole pile of shit.
Yeah. Really, so most of what I really care about is aggregated open interest, right? Because okay. So the way open interest works is it can only go up if both sides of the position are opening a new position, right? On perp markets. So open interest only rises if somebody is opening a new long into somebody who's opening a new short, right? Because that's the only way there can be a new contract created. Otherwise, because if somebody already has, a long contract and they're just selling it to somebody who wants to open a new short position, that doesn't actually result in the creation of any more contracts. That's just the same amount of contract staying same. The only way for open interest to go down is when somebody sells into somebody who's also selling their position, right? So both people have to be closing or both people have to be opening for open interest to actually change. So, which is like, that sounds like a fairly obvious sort of basic fact, but a lot of people seem to not understand quite how that works.
Not to get your head around.
Yeah. But what you can kind of see is anytime you see a massive open interest spike, what that means is obviously both sides are opening, right? So if obviously here we see a massive open interest spike at the same time that price is going up, right? Which means somebody's being aggressive in opening. The aggressor on the market, the person who's taking on the market, is the person who is, getting long, the person driving the price up. Because the market maker is the market maker is opening new short positions, right? Because they're resting passive liquidity.
But this isn't the market maker. This is someone doing fuckery aside from the market maker. So we have two players.
No. What I'm saying is for the open interest to go up, that means the market maker is opening a short position while the aggressor is opening the long position, right? But both positions are being open.
We have two players. We don't have an internal market maker pulling a scam. We have an aggressor, probably a market maker in their own right, or at least with market maker infrastructure. And we have the internal market maker, which is the HLP on Hyperliquid. Or is that right? Okay.
Right. So yeah. So the market maker is not the one doing fuck shit, right? But the market maker is also opening a new position that they didn't have before, just because the aggressor is taking liquidity from them, right? So these are just the market dynamics to understand. So we have the aggressor, the guy who's manipulating shit, right? He's opening a new position. And the reason we're seeing an open interest spike is because he's opening his position into the market maker, who is also forced to open a new position because they're providing the passive liquidity, right? A forced opposing position. So that's the only way we get open interest spikes here. And you can also get open interest spikes. We don't really see it on this chart anywhere, but when price goes down, that can happen as well. Where the aggressor would be taking short and the market maker would be the one opening long.
But this $50 million market cap coin that now all of a sudden has $90 million, $100 million worth of open interest.
Right. So once we understand kind of what's going on, so because we know the main entities who have who have like open positions, now we have to kind of consider like what does that mean? How are each of them going to handle that? Right. So for example, the way we want to play this, obviously, since whoever is being the aggressor and pushing it up, they're the one also creating the massively attractive positive funding rate, right? Because they're pushing the price of the future above the price of the index by a significant.
So let's talk about that a little bit. Usually, the situation for a shitcoin is that you get paid to that's going up is you get paid to short it. Here you get paid to hold, which is a very different and unusual situation.
Yes.
Do you want to add that a little bit?
Yep. Yeah. So basically, because this guy who is pushing open interest up and pumping the price up, he's being so aggressive taking liquidity from the market maker. The market maker doesn't want to offer him good prices because the market maker doesn't want to have to take on this massive short position, right? So they're quoting higher and higher than what the index price actually is, right? Than what the quote unquote fair price is supposed to be. So every time this guy
doing that is because the market makers are kind of scared and they're quoting wider, and as well there's some spot manipulation, so you get a double fuck you and it's creating like a positive. Is that what's going on?
Kind of. That's what the guy who's trying to do this is trying to accomplish, right? He's not there when they see this happening. It's not always going to be successful. It kind of depends on the level of commitment and how much capital he's willing to potentially burn. But
okay, so let's dig into that. So a lot of the people on this call are very new to this kind of thinking, and they're stuck in like lines on charts land.
Gotcha.
So if you're going to manipulate a coin by spending money to drive the price up, that costs money. You want to make money. If you don't make it,
well, because here. So let me actually. I'm gonna pull up Paint and maybe I can like draw something and kind of explain this here, right?
You get on the left hand side. There's a paintbrush. You can just draw shit.
Yeah. Well, I can try that. Come on, there we go. Why is it not? Yes, that is what I'm trying to do. Okay.
And you just hold them.
Okay. Okay. So if you think about price as just like fair price is this, right? This is the index price. Anytime the future, aka this perp, is trading like down here, right? That it's trading too low. It's supposed to be up here. So what happens is if it's trading down here, then since the index price is trading too low, it'll pay people who are getting long, right? Because if you buy here, they want to incentivize people to buy here. So whoever buys down here, well, the perp is trading down here.
The spot
is below where it's supposed to. They get paid to hold that, right? So that's where the funding mechanism comes from. So this is the fair price and of the market, and that's determined by the index price, which is where they're looking at the spot market, which is where spot coins are actually changing hands. But if you're buying on perps, if the perp price is trading down here, the exchange is going to give you money in the form of a funding payment to buy down here, and it's being paid by people who are willing to sell down here. The people who are selling end up paying you a funding rate for doing this, right? And the opposite happens if the perp market's trading too high, if it's trading up here, and then you get paid to short it because they want people to sell it while it's trading above where it's supposed to. That's how that's how perp markets trade more or less in line with the price of the actual asset, right? Which is this big line right here. So that's kind of the mechanism that perp markets use to keep prices where they should be, quote unquote, you know,
Just
in regards
post it
to
in the chat. So, do you want to
Say
drop
what?
that down to an hourly chart? And then do you want to drop that down to an hourly chart or a 5-minute chart and see what's happening? Because it's
Yeah. So so what's happening right now is since it's very funding attractive, right? We know that this price is trading below what the index price is, right? Because the exchange is paying you
price
to
is the
long.
spot price, the price of the real price of the coin. This future is like a gambling mechanism. It's like a separate gambling market on the price of the coin.
Correct. Yep. Yeah. So
Interest.
the only reason these prices would be off is if there are people who have a reason to trade at bad prices, right? Like because they know they're trading at a price that is not quite right. But the reason for that is because they're either forced to trade or there's just nobody who's willing to trade with them at good prices, right? So when you see situations like this where open interest pushed up really, really high, this means that somebody is opening long, like somebody is buying on this thing, right? And their counterparty is forced to sell into them. Now, as soon as you start seeing funding flipping long, that means somebody is aggressively selling. Okay? That means the opposite. So if funding is being flipped long, this guy is actually the guy who bought all this stuff is starting to sell at
Do you
bad
want to,
prices because
do you want to just
prices
load
is
up,
going
do
to be on.
you want to just load up funding rate in the indicator so we can see that?
Yeah, we can do that. We'll do aggregated funding. There we go. So aggregated just means showing. Oops, that's not what I wanted to do. That just means it's showing like the aggregated rate across all exchanges there, right?
So when that funding flips positive, the guy who's doing this fuckery is starting to unload his position on the unwary dumb fucks. So what he's kind of hoping to do is that a bunch of retail guys see, oh fuck, that's a fucking great chart. Oh fuck, it's the runner of the day, or whatever the fuck they think, and jump in. And at that moment, he's going to start unloading his position and then dumping, and then ideally accumulating a short position and then dumping on everyone's head and full stack Hitlering, right?
Ideally, I think, yeah. So
that's a perfect. But he might only get half the crime. He might fail at the first part and give up. He might.
Exactly. So like at a very base level, looking at markets, it's a PvP game, right? Which means you got to be thinking in terms of, okay, who's first of all in a spot where they could get fucked, and how can I either ride along with the people that are fucking them, or otherwise take advantage of this somehow, right? So when you see shenanigans like this, you're like, okay, somebody's clearly accumulated a large position, which means they're vulnerable in some way, right? They can get fucked. It's possible for them to get fucked somehow.
Let's pause it there. So some key things that you said. It's a P versus P game, which means it's a player versus player game. Your job as a little guy is to, unless you're a market moving guy yourself, which none of us are, you're trying to figure out who's who in the zoo.
Yes. Yep. Exactly.
And you're trying to figure out, so it's entirely possible that someone just like us could be watching this now, but they have a $10 million side wallet that they're prepared to go fuck with this guy. And they think, fuck, he's spent a lot of money. I could fuck him. He's got a lot of money invested in this.
Yeah. Yep.
So
the reason they want to do that isn't necessarily out of animosity. It's because anytime you can force somebody to do something in the market, that means you can take advantage of whatever you are able to force them to do, right?
so let's pause that there. This is because forced traders generally trade at bad prices. And you see time in liquidations, like if your stop loss gets hit, you don't get a choice at what price you got. You just have to look and hold your nose and go, that's the fucking price. They fucked me. Of course they fucked you. You didn't get a choice. So the idea is that when we see situations where people can potentially trade at bad prices, we want to be very, very interested in that.
Yep, 100%. Because if somebody's trading at bad prices for them, it means it's good prices for whoever's on the other side of that trade. So hopefully we want it to be us.
And ultimately, despite how I sort of fucking dumb it down, ultimately, there's no real fucking way to make money out of this other than trading at good prices. Like really, you strip all the bullshit away. You've either got to be buying cheap and selling dear. It's selling expensive at some point. Well, you're not going to make any money.
Yep. You can either buy first and sell later, or you can sell first and buy later. But either way, you got to get a good price for at least one of those. So yeah. So again, so coming in with that mindset, you're kind of looking at, okay, who's getting screwed or who's vulnerable to it, right? With these three pieces of data, okay, let's actually ignore the chart for right now and just look at these two things. So the aggregated open interest coin scandal is basically, okay, we know there is at least two people with opposing positions. One person is really long, one person is really short, because that's the only way that open interest can go up, right?
Okay,
And it's gone up by a lot.
so let's pause that there. I think that's a very, very key. We've got two guys who are in literal combat in the order book. One of them's going to lose a shit ton of money. The other's going to gain a shit ton of money. This is the game. We got to decide who the fuck's going to win.
Yeah.
Sorry.
Yep. So we know that that's the situation, right? We know that there's these two guys. We also know that we can't do fuck all about it, right? Because, yeah, I mean, none of us are throwing around, what, $70 million here? But those guys can't. So we want to ride along with whoever's winning. So we got to figure out who that is. So that's the goal. Because we can't really have any impact for ourselves here. Enjoying the fight, we can just kind of coast along and ride the tailwinds, so to speak. So one way we can kind of look at and see, okay, who's winning or who's likely to continue to win. We see, okay, this funding rate here, as soon as this position started loading up, whoever was long actually had the advantage, right? And the reason we can see that is because as soon as this position started loading up, the market started paying people who were willing to be long, right? And we can see that by the funding rate. So the funding rate looks, you kind of got to flip it in your head. Anytime the funding rate is negative, that means it's paying you to be long. Anytime it's positive, it means it's paying people to be short, right? And this rate here is weighted 8 hours average. So at the very peak, over a period of 8 hours, these people are getting paid 2.5% in the period of 8 hours on average to be long. That's a pretty hefty advantage, right? That's like, if you want to be on that side. And we can kind of see that as it's reflected in the chart because it's going up, right? Now, I haven't taken a look at the spot chart and compared the two. That's a little bit, that's probably a little bit too much detail for the call, and it's not really that important right now. But what we can see is even recently, even with more and more open interest, like this is still ongoing. We still see that whoever's long is going to continue to get paid, right? Like this is sort of aggressively still ongoingly happening. So until this changes and flips the other way, whoever's long has the advantage, right? Now that doesn't mean necessarily that if you buy here, you're going to make money, right? Because this is still trading and everything is still probabilities based. But, what we can say is, okay, being long right now, because this value is so extreme, because you're getting paid so much to do it, what that means for, again, let's go back to our two participants. We have one guy who's really long and one guy who's really short. Scott, this isn't a trick question or anything. Like, what do you think is happening to the guy who's short right now? Like, just looking at this chart, what's happening?
The guy who's short is paying 1,000% a year, which compounded is a fucking hell of a lot. He's bleeding out the ass, and he's thinking, do I cut bait and reduce my position, which will which will push the price up further, or do I reach into my back pocket, pull out $10 million, slap it on the table, and say, I see you, I call. Is he folding or is he gonna call?
Exactly. But either way, he's the one on the ropes, right? The guy who's long, he's fucking happy. He's getting paid shitloads of money to be long, and the market's up like what? Let me take the he's being paid shitloads of money to be long every hour or 8 hours or whatever, and he's up 50%. Like, this guy's happy as fuck, right? So the guy who's long is clearly winning. And as long as he's still getting paid to be long. He's going to keep winning, or he's going to have an expectation that he's going to keep winning. Whether he actually does or not, again, that's kind of debatable. But just like a coin flip, if I offered to pay you every time it landed on heads and there was no downside, it doesn't matter if you flip it and it lands on tails. It was still good for you to play the game, right? That's kind of the position he's in, where he's like, it's still good for me to hold long, regardless of how this ends up turning out.
Correct.
So that's the position this guy's in. Therefore, that's the position that we also want to be in, right? We want to be on the side of the guy who's got the best odds.
Okay, so let's pause that there. This is fundamental to crypto. You're a little guy. You're not manipulating markets. You want to trade alongside. God is on the side of the big battalions. You know,
Yep.
you want to be on you want to be on the winning side.
Yep. And it sounds dumb, and that's why. And we're using a bunch of fancy numbers and indicators and whatnot to show this. But trading really is kind of that simple. You find somewhere where somebody's getting fucked, and you figure out who's giving them the dildo, and I don't know, you go fluff for that guy or something. I don't know what that would be in the analogy here, but you want to be on that guy's side. So, in very simple terms, that's all we're trying to do here. And so now that we know that, we know what side of the market we want to be on, right? And we know which side right now is the winning side. The next step is we want to know when that side's not going to win anymore, right? Or when the advantage is gone. So how are we going to know that? Two things. Again, well, so the guy who's getting fucked right now, the guy who's short, he is going to continue getting fucked, and eventually he's going to have to offload his position, which means buy, right? And if he's willing to buy, what that means is it's going to put the price closer and closer to actually fair price.
The
Right.
premium, so the premium and the funding rate are going to normalize, maybe flip short because it's a shit coin, but that open interest will go down at the same time as prices going up.
Exactly. Yeah. So the guy who's getting fucked, he's going to want to close his position, right? So he's going to want to close his position out, and in doing so, he's going to make this premium. It's going to shrink, right? So it'll get closer and closer to zero. So we're not getting paid as much to be long. And this open interest should go down. It can also stay flat or go up if there's been enough interest attracted from other people. But
Okay, so
this is
more
interesting.
expect to go down. So let's pause that there. The situation where open interest might not go down, like open interest should go down if he's aggressively getting out of a large position, but it might stay the same if a bunch of retail guys think, oh, fuck, that's a great chart, and jump in and they'll just take over the position.
Yep. Yeah, exactly.
Okay, is it in the chat? Is everyone with us so far? See how different this is than Bitcoin. Like Bitcoin, we've got 1,000 participants. Like here, we've got 2.
Yep.
Okay.
Yeah.
So
and we might have plenty of other participants too, but it's but really, what matters. It sounds funny, but what matters is the participants that matter, right? And we can look at each other and go would
you mind doing
ego aside, we don't matter in this market because we're not pushing the market, right?
Would you mind doing a quick recap, like a 30-second recap from the start for the people who this is the first exposure a lot of these guys have had to proper player versus player trading.
Gotcha. Yeah. So just a quick 30-second recap. When we see some weird stuff happening in the market, we want to look and go, okay, there's going to be 2 sides of every story, right? There's going to be whoever's driving the weird stuff. There's going to be somebody who's winning and somebody who's losing. And both of these sides have to be equally sized in power or equally sized in size, because I can't buy 100 million worth of something if somebody isn't willing to sell me 100 million worth of something, right? So on any sort of action you see in the market, there's going to be 2 sides, and one of those, and then our job is to figure out which side is getting fucked and which side is doing the fucking, and we want to join the side that's doing the fucking, right? That's at the high level. That's all we're looking to do. Did I lose you?
So, what do you see? Do you want to drop it down to a 5-minute or a 1-minute chart and tell me what you're seeing happening right here?
Yeah, let's do it. See, 5 minutes. Okay. Yeah. So like just in the time that we've been talking about this, these past few minutes here, what we're seeing is obviously even more open interest increasing, right? So that means like the person who's getting long is doing that even more so, or somebody else new decided to join the party and do the same thing that has a decent amount of size.
So
But
let's
this
talk
is
about
a lot of
that.
size.
So we could have a situation where another serious player saw, fuck, this one's in play. Let's join in on the side and we'll have ourselves a bit of a gangbang. That could happen, but it's probably not the first thing you'd think of, is it?
Right. Not necessarily. And the truth is, it doesn't really matter that much.
Doesn't matter.
At least in a situation like this, because well, whether we think of this guy as being 100, like 100 raccoons in a trench suit, or if we think of this guy as just one dude, right? Or some evil, I don't know, evil market maker, banker dude, whatever the fuck, who cares? It doesn't matter how we think about him. It doesn't matter how many people it is actually, because they're all in the same situation, and so we can sort of understand their behavior and their motivations in aggregate.
Okay, so let's pause that. So what we mean is that if I try to guess what everyone in the chat had for breakfast, I couldn't. But if I lock all you motherfuckers in a movie theater and then lock the back door and then set fire to it, I can predict with a high degree of probability how you guys are all going to act the same. You're all going to fucking try and get out. Like this is what David's talking about. It doesn't matter if it's one giant guy or if it's 100 raccoons in a guy suit.
Yep. Yeah. Because they're going to have to do the same thing regardless, right? We know that there is approximately this much money positioned this way, and so it doesn't matter if that's a million people with $1 or if it's one guy with $1 million. It's still $1 million, or in this case, about what is that? $25 million worth of open interest that has to go somewhere, right? So it doesn't matter who controls it. We know the situation it's all in.
You'd be long now.
Yeah, I would. So because what we're looking at here, so as we see open interest ramping up on this price spike, but the premium is actually paying longs even more and more. What this means is there's somebody that these guys are buying into somebody who is very, very, very aggressively selling. Right? Because if somebody is willing to sell at bad prices, which is why there's this incentive for people to get long, that means that person is panicking and has to sell, right?
So there was a bunch. So is this an engineered short squeeze, or is there some reason have they picked this?
Well, so that I'm not really sure, and I don't honestly care that much.
Yeah.
Right. Because all we really need to know, again, we're not trying to figure out necessarily there are situations where you want to dive in a little bit further and where that actually matters, but here it really doesn't, because all we really need to know is that there is a lot of basically that there's a lot of aggressive selling going on, right? That somebody is really, really aggressively selling this market off, and they're willing to pay us quite heavily to do so. And that the longs are winning. Like being long has this massive advantage to it, right?
And that could be people who've been trapped bag holders in this for a long time. It could be insiders who know the project is dead, who are going to sell out on any sort of pump. It could be anything. It doesn't matter. Right?
Well, right. And so a lot of the time, what it actually is, let's take it and zoom it back out. Let's look at this chart. Is this a chart that you want to be long? Like just looking at it in general, is this a chart that has really at any point in time rewarded being long by very much?
Great technology, great chart, promising tech.
Right? It's not, right? Like generally speaking, this looks like something you want to sell because it's just died for the entire history of its existence, right? And so when you see these pumps, a lot of times you might see this sort of this willingness of people to be like, oh, it pumped. I expect it to not keep doing that. So I'm going to aggressively sell, right? And so then you see these open interest things where you see these massive open interest spikes. But if somebody's willing to sell at bad prices, and yes, this is a chart that over a long period of time, you want to be short, right? But what happens when this guy sells right here? because we've seen this happen before, right? Like we saw a massive spike in open interest right here, and somebody sold into this spike. And yeah, it did come back down, and so did the open interest. So they kind of maybe made some money there, right? But they weren't paying nearly what we're getting paid right now, right?
So we're,
And
we're so
even
the
in that situation,
funding rate is
say what?
really squeezing these guys. That's what you're trying to say. Like everyone who's short this is like waking up and gone, you know, I was prepared to pay 70% a year, 100% a year to hold this. It's fucking 2000% a year yesterday. It's like my fucking nuts, they're on fire. Like what
Yep,
the fuck?
exactly.
Stop.
Because this is not paying 1,000% a year for you to be shorted, right?
Okay,
Like
so
by
this
holding
is
position, you're not making 1,000% a year because it doesn't drop that fast.
so
right?
so this is important, and you first taught me this. It's not about what percentage people get paid to short. It's about, am I getting paid 1,000% a year? What is it costing me to short? If it drops 50% a year and I'm paying 20% a year to short, I don't give a fuck. If it
Yeah, because I'm winning.
yeah, because I'm right. If it drops 30% a year and I'm paying 50% a year, then all of a sudden someone's got like poking me. And then that poke becomes like something more violent after a while, and it actually starts to hurt.
Yeah.
And then it does real
Yep.
damage. And what you
Yeah.
want to is the situations where one side. So what happens if the shorts decide, fuck, this cunt's going to keep doing it? It looks like he's got an unlimited stack. He's coming for me. He's coming for me with violence. I don't want to wait until it squeezes up to $1. Like, fuck. Like
Well,
this,
then, yeah, exactly. The shorts are paying so much money right now, and they're not making it at the same rate back. So they're getting that poke, like you said. And so what eventually has to happen is the shorts go, well, fuck, this is a bad idea. I don't want to be holding this. I'm not like it's a bad position. I'm not winning. I'm not getting paid, right? Because I'm paying so much just to hold this position. It doesn't even matter if it goes down because I'm paying more than I make off of it going down. And the short says, okay, like this is a bad position. And so the short, whoever's holding the short says, okay, well, fuck, I have to close the position. Well, what does that mean? Well, if a short is closing a position, how do they do that? They have to buy back in, right? So if you have all this open interest, whoops, I didn't mean to do that. That now all of a sudden has to get out, right? Because they're paying more than they're making.
so the
Well,
original
that's a
was
whole.
about 25 million bucks, right?
Say what?
The original open interest was about 25, 30 million, 30, 40, 25,
Yep.
something like that.
Looks like 23, 24, yeah. Yep. So, but then you see the spike, and now all of a sudden we're all the way up at 110. That is now essentially like the difference between these two. And again, I just woke up, so my math's probably off. What is that? Like about $85 million worth that at some point has to normalize itself and it has to buy back. Because if they don't do that, they're just losing money out the ass, right?
A couple of more subtle points about this kind of flow trading. First of all, you can model this in your head. You don't have to do it like super nerdy with a spreadsheet or regressions or anything like that. As long as you get the directionally, as long as you get it right, you're safe. You know, you don't need to be too precious about this. David has some maths, but he doesn't have much maths. Like you don't have to fall down a nerd hole about this. You just have to get it roughly directionally right.
Yep. And I just say because that's the thing too, is like all the big guys, all the guys who are way smarter, they're doing all the math and everything like that. It's like if we have less money than them, and we know that we don't have I don't have 6 dudes sitting behind me cranking out numbers, right? Like I like why would I try to compete on that? I just want to I'm like, okay, they've already done the numbers. I'm just gonna ride along with the guys who seem to be winning and did them right. Simple as that.
Fuck yeah, man. How good is this, guys? How fucking good is this? Right?
Wow, that's quite insightful, man. Really good, really interesting. Very interesting to wait. Yeah.
Now,
Awesome.
what we're going to do on Friday, we're going to open up to you guys on Thursday is this motherfucker going to be trading with me. He and I we're teaming up to trade some fucking janky bullshit in a hyperliquid vault. Do you want to talk about how we're going to fucking to quote Conan the Barbarian, what are the best things in life? To crush your enemy, see the, and hear the lamentation. You want to
Indeed.
have that?
Music. Yeah. So what we're doing here is, so we talked a lot here just about like funding and open interest and things like that. So what our strategy is on Hyperliquid, actually, this is something I use a lot, and I've used this for years. I've written like threads on Twitter and stuff about it. We're using a very similar strategy on Hyperliquid, where we are identifying basically what is paying the highest right now to be both long and short, right? Where's the market willing to give us the best absolute prices? And we're taking a list of the top assets that are paying us to be short and the top assets that are paying us to be long, and we're balancing those positions against each other so that we're roughly market neutral on average, with the goal of just collecting funding rate and good prices, right? So I'll give you an example of what this looked like. Like a couple days ago, we were short Doge, and we were long like Melania, right, on Hyperliquid. And the reason for that is because Doge is paying us to be short, right, and Melania was paying us to be long. And although those assets may move at different rates, and so we might make or lose a little bit more on one side than the other, when we do that dozens or hundreds of times with a bunch of different pairs, on average, all that difference sort of washes out. And over a long enough time scale, we just earn the massive funding rate. And Melania was paying something. I think it was like at the peak, it was like 546% a year. And it's dropped since then, last I checked. But
so what we're trying to do is, in technical terms, we're trading what's called the stat arb carry factor, and we're trading it in tails where we have a real advantage, because in the tails the carry rates are enormous. The problem, you can get paid 500% a year for shorting some shit coin that's going up, but the problem is that might not be that what if the market goes up and that shit coin goes up and you're going to get fucked? We're gonna hedge that bet that something's going to go up with another really crappy bet that pays us if the market goes up. So we're gonna try and stay roughly. So let's talk a little bit about details. How balanced do we stay? How many coins do we take? Like, what positions are you in? Like, he's just fucking around doing it with a little bit of money now. But what positions are you in now?
Well, let me check and tell you. As of right now,
and you're up about 50% for the month, right?
Beg your pardon?
You're up about 50% for the month. Last time I checked.
I'm sorry, you are cutting out. I heard you were up.
You're up a lot for the month. Last time I checked, right?
Last I checked, yes. Actually, I don't have my wallet connected on this computer.
Okay,
Let me just look at it. I can still look at it in the vault.
Okay, so this is another useful thing. The biggest security thing you can do is the computer that you use for Zoom and internet browsing, and the fucking one you do your transactions on. That's the biggest one you can do.
Yep.
Biggest.
Separate. Yep. You want to keep those separate because, like, I've yeah. Here's the story. Scott, for some reasons, like I did not hear any of what you just said, but
I was just dunking on you.
Oh yeah. So I was hacked because I had an actual Zoom call, like what we're on now. Except I was right now. I've since only used the web browser version of this. But if you download the Zoom app, there is actually an exploit in it, where people are able to, like, if you can hop on a call and they actually can have like a remote control of your computer. Without requiring the permission that you're usually supposed to have to give them. They're able to bypass that step. And so somebody had an attack on me where they set up a call. We hopped on a Zoom call, and they were actually able to clean out my hardware wallets, or not my hardware wallets, my soft wallets. So and this is stuff like
David and I had run like 53 grand up into 188, and they stole it all. It was a hateful day.
Yeah. Yep. Yes, so I see the chat. Yeah, don't download the Zoom app. Just use the web access one. So I got with that. And so now we use separate computers for everything. Also, I use hardware wallets. I highly recommend that. if you have really any more money on chain than it costs to have a hardware wallet. But let's get back to the question. You said, what kind of positions do we have right now? Positions we have open right now, we are short Hype, we are short Popcat, we are short Pepe, or KPepe because they measure it in thousands, short Doge, and BNB. And we are long Bera, IP, Banana, Badger, and Move. So we have a basket of 10 assets. 5 of them we are short, and 5 of them we are long. And what's happening is we are getting paid funding to be on all of these positions, actually, except one, which is BNB, which I need to deal with. But the goal is to get paid.
BNB flipped long, man. Flipped really long.
Yeah, I did. Yeah, that just happened yesterday. It looks like. Yeah, so I gotta figure that one out.
Okay, and let's talk a little bit. Okay, so here the way David's talking is the way a lot of retail traders do things is I've got an entry set up, I've got a stop loss, and I've got a target. That's generally not how you'll trade if you work in a firm. There are exceptions, but generally not. The way that you generally trade in a firm is you completely forget about all the shit that you did yesterday. You wake up and you go, what positions do I want?
Mhm.
And then what, as in which trades have edge today? And then what positions do I have and do I cost effective to trade towards the trade? So we're holding a portfolio and adjusting that portfolio up and down every day, which is actually what FINREV does. And it's actually what market makers do. It's what Jane Street does. It's what every big hedge fund does. They don't generally do this entry, stop loss, target thing. Why? Because that's very inefficient for costs. And stop losses, a stop loss has a couple of things with it. One, it's inefficient as hell. If you've ever had it tick your stop loss out and then win, that's a cunty thing. That's actually inefficient, reduces your risk adjusted returns. And the second thing is the market doesn't know or care where your stop loss or target is. And the last thing is technically any stop loss turns any trade into a trend following trade. So sometimes the trades that you take are not trend following trades. This isn't a trend following trade. This is a simple trade of there's someone committing a crime and we want to see if they win, we want to be on their side. If they lose, we want to see them lose and see them get carried out on a stretcher and ride along with that. So it's got nothing to do with momentum. So adding a stop loss to it is nonsensical.
Yep. So portfolio construction at its most basic level is I have this pile of money, whatever size pile that happens to be. It could be, let's say, $100. And I want it to have these properties, right? I want this pile of money to exhibit this set of properties, right? Now I'm going to take part of that pile of money and I'm going to allocate it to assets that add some amount of these list of properties that I'm interested in, right? That's all portfolio construction really is. And like Scott said, that doesn't really include a stop loss because you're not necessarily betting on a specific thing necessarily in a specific market. You go like, okay, if I buy $10 of ABC, it has this expected return and these expected costs and at this level of volatility. And these are all these are all things that I would like to add to my portfolio. Like these are all things I find desirable for my portfolio. But now maybe let's say the costs were higher than I wanted them to be. So I'm going to offset this position in ABC with a short position in XYZ because XYZ doesn't necessarily make me any money, but maybe the position is only $2 and it reduces the costs of the total portfolio because maybe I'm getting paid to hold XYZ, right? And I don't expect it to go anywhere. It's just going to go flat, but I'm getting paid a little bit to hold it. And this could be something like treasuries, right? And so you're constructing a portfolio where you're like, okay, now I have part of my portfolio in this thing that I expect to go up. It's got this level of volatility. The costs are really high, so we offset the costs using XYZ. And now we have a portfolio that goes up like this and has acceptable costs, right? So that's the thought process behind like portfolio construction in general. And like Scott was saying, you don't have sort of this expectation of like, oh, stop loss because maybe XYZ wiggles a bit too much. It's like, no, as long as it's still providing the qualities that I wanted to be adding to my portfolio, we're all good, right? And so that's kind of more the thought process on how this goes, and that's kind of the approach we're taking here in the Hyperliquid Vault. where the main properties we're looking for, we're not so much looking for betting on whether crypto coins will go up or down. The momentum system that we have is already great for that. What we're betting on is we want a portfolio that is on average very low volatility and makes money over time, right? And so what we're doing is we're balancing these long and short exposures against each other and making sure each of those exposures have a payment function attached, which is the funding rate. So we're getting paid off over time, and on average, these things wiggle, but they all kind of balance out, and we get what should be a steady line, or a relatively steady line within our volatility parameters. So that's a bunch of nerd talk basically. We're buying some shit and we're selling some shit in about the same amount.
From Cheryl, how do we know when to get out? So we want to really simplify our trading, and we're taking a trade when we have edge. The edge is we're getting paid to take that trade. When do we get out of that trade? Well, when we don't have a fucking edge anymore. So when it stops paying,
whenever they stop paying,
whenever they stop paying us to be in the trade, we're out.
Yep, exactly.
So if someone wants to pay me 1,000% a year to hold some fucking shitcoin, and I can roughly hedge out the risk of holding that shitcoin by going short a similar shitcoin, so that fingers crossed, if the market crashes, how the shitcoin will go down, and I'll get paid for that too. And fuck, I don't care. I don't look at the charts. I don't draw patterns. There's no, it has to hold this key level. There's no support or resistance. None of that shit comes into your mind. It's just really, am I being paid for this? And am I hedged properly?
Yep.
How often are you checking and adjusting the portfolio?
So I'm checking it every few hours. Usually between at least every 4 to 5 hours.
I know you don't have to be that precious, man. I know you're putting your best foot forward, but like twice a day is like okay.
I say I know that, but I'm always in front of my computer anyways, man. So it's just like I'm like, oh, I wonder what's happening. Oh yeah, okay, well it looks good. You know what I mean? It doesn't take a whole lot of maintenance. But I'm not usually adjusting it actually that often. Usually stuff stays pretty consistent, and I don't have to trade in or out of stuff that often. Because again, we're like, we get into a position when it looks like it's going to pay us to be in there, and then we just stay there until it stops being the case. Now, right now we have 10 positions open, and one of them changes. Sometimes only one of them will change, but usually it'll change on market terms and fluctuations. So I'm either changing half of them or none of them. But I usually only end up making adjustments every couple days, maybe. So
it's like that. It's like that. You want to check it twice a day, but you're probably not touching it. Now, the cardinal rule with the types of trades, carry trades, is while you touch them, you lose money. So every time you touch the trade to adjust it, you probably lose somewhere between 8 hours and 24 hours worth of the money that you made.
Yeah. About right? Well, and the reason for that is because it costs money every time you trade in and out of a trade, right? And so we're earning these funding rates, and some of them are high, but they're not always high. And so if we're getting paid out every hour, and let's say we're getting paid 1 basis point, 1/100% per hour, and it costs us 3.5 basis points plus another 2 basis points in spread to adjust our position, and I just decide to change the position just because I feel like it, maybe all of a sudden I've lost 10 hours in total of what we've just been earning for holding the position. So really, the longer we can wait.
Key difference between David, who's a professional, and the amateurs who are watching this now is that professionals really care a lot about trading costs, a lot. And if you want to know, is someone a good trader? Really, that's the first thing that you look at. Like one of the, if you want to hone your LARP detector for other fucking trading influencer asshole guys like me, the LARP detector is how much do they care about trading costs? That's one. And also, how much shit do they do at once? Like if they claim to be doing 100 different things, they're probably doing 0. We're doing this one specific thing. It's still a job. It's still a job. Like I with my workload running a company, I couldn't I did it on OX for a while, but I didn't like it. So
yeah. It takes a bunch of time. I mean, and most of what I'm
Mm.
doing is while I'm not trading, I'm writing code right now because I'm building a tool for setting me up to be able to run data more effectively. Is what I'm working on. But again, like I do this professionally, and it's a lot of trading as a job is not trading. You're not clicking buttons or doing a whole lot. You're mostly monitoring things and figuring out, and most of the time is spent working on new strategies, which will also involve not trading very often, ideally. So
So basically, the deal that we're going to offer you guys on Thursday is you can throw some fucking money in this vault. It's a hyperliquid vault, and David gets 10% of the money. He's going to get it, not me. Yeah, and I think that's pretty fair for someone like watching it all day, every day, doing a great fucking job. And stick some of my money with him. I've already stick some of my money with him. It's just someone stole it all. But yeah, he's you can tell, you can tell he's very good. And you know, a lot of you have always said, I wish I could trade these meme coins. I wish I could trade these small garbage coins, but I have a job. I don't know enough. And I get the feeling that if I try and trade this perpetual futures, I'm going to be the one who's getting fucked. You know, if you don't want to be the sucker at the poker table, and you don't want to send yourself insane, like I've nearly been in a mental hospital many times doing this for too long. Maurizio knows what I'm talking about.
Yep.
You know, you just do it. You just do it 24 hours a day, 7 days a week. And then you wonder why, like, fucking, I'm angry at my cat. You know, like you want yeah,
it's the meme, right? It's the old grandpa that says, "I'm 27. I've been in crypto for 5 years. I feel great."
me, by the way. It's literally me. I aged so badly in the last 5 years.
Mm.
Yeah, so guys, sorry for monopolizing the call, but I think it was cool, right?
That was amazing, man. Like honestly, learned a lot. To be honest, great to know you, David. Mm.
You know, and I think this is an important thing. I'm always looking for traders who are better than me. I don't want to be you know, one thing that really retarded my growth as a trader was being like the guy who was like supposed to be a good trader and telling everyone else how trading works. Now I'm a bit more fucking humble because the market punched me up a few times. Now I'm a bit more humble. Now I've learned a lot more, and I've learned a lot of what I know about perpetual futures from David. Yeah.
Amazing. Well, I'm looking forward to the end of the week.
Fuck yeah. Say what you like about
Yeah.
Scott. Say he can recruit some fucking staff. Have a go at this. Have a go at this. All right, guys.
Well,
See
thanks
you
for having me on, guys. And yeah, it's this one's a fun one. I'm excited about it. So
Yeah, you got yourself a new fan club there, son. Oh, follow him. I Draw Charts on Twitter. I Draw.
yes, I am on Twitter. If you like shit posts and occasional kind of talks like what we've had here, I do occasionally write threads and stuff like that. So
Yeah, he wrote some good threads. All right. See you guys.
Cheers.
all right, thanks so much, everybody.